Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following in the BNN Bloomberg newsroom. Canada has reached a new trade agreement with China. The Prime Minister, Mark Carney, says Canadian tariffs on Chinese EVs have been eased in exchange for reduced levies on canola exports. All of this takes effect March 1st. Carney met with the Chinese leader, Xi Jinping, looking to reset trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
The Ontario Premier is condemning this deal with China. Doug Ford says the agreement gives Beijing a foothold in the Canadian market and will be at the expense of Canadian workers. In a statement, he highlighted that Ottawa is inviting a flood of cheap made-in-China electric vehicles without any real guarantee or equal or immediate investment in the Canadian economy, auto sector, or supply chain. WestJet will go back to its old seating map after reviewing traveler feedback. The company says it will remove one row of seats in the aircraft to create more legroom in economy. The airline CEO said the company will take what it has learned from this and continue to be cost disciplined and innovative. Shares of Novo Nordisk getting a boost today. The pharmaceutical company got approval from UK regulators for a higher dose of its Wegovy drug for obese patients. Novo has also seen robust sales for the oral version of Wegovy in its first week on the market. Some analysts believe the approval and higher than expected sales could offset challenges associated with price cuts. Here is where we are on the markets right now. The TSX losing 18 points on the day to 33,010. Let's go south of the border. The S&P 500 not a material move today. The Dow Jones dropping 87 points. And the NASDAQ, again, not a material move. It is down today about 2 points. As we mentioned, Ottawa and Beijing have reached an agreement that reduces tariffs on products like Canadian canola and Chinese electric vehicles. The move on EVs is one the auto industry in Ontario is not happy about. Let's go to Flavio Volpe, president of the Automotive Parts Manufacturers Association. He joins us now. Flavio, what is your biggest concern about this tariff reduction on Chinese EVs?
Well, just remember that we asked for the tariffs to be put in a couple of years ago as the Chinese manufacturers and Western manufacturers using Chinese factories started to encroach rather quickly into Western markets. We'd made a series of investments in this country that we needed some time to bear some fruit. And so we got those tariffs successfully put in here, U.S. and Mexico. Now, the Chinese retaliated, of course, by attacking other sectors of the Canadian economy. And we understand that the Prime Minister, of course, has a responsibility for the entire country. But today we gave up 3% of the market here on the promise, perhaps, that the Chinese may invest here, reviewable over 3 years. Today's a good day for those agricultural sectors. We've restored their some of their market access to $3 billion worth of exports, but those 49,000 cars are worth about $2 or $3 billion here. So we paid a price here. We're working together with the government on other measures. We have to remain vigilant that this doesn't become a permanent foothold that expands through the market like it did in Europe and put all those local manufacturers on the back foot.
Okay, so talk to me a little bit more about how expensive these cars will be. Will they be a less expensive option for Canadians? How do they compare?
They could be, but right now, to sell a vehicle in Canada, you have to meet the Transport Canada safety standard that only Teslas made in the Shanghai factory or some Volvos and Polestar vehicles are available. So in that first year, that quota will be the same vehicles that Canadians wanted from Tesla, but out of Shanghai. There are other vehicles, ones that BYD makes, the Seal, the Dolphin. These are $12,000 and $15,000 vehicles from the factory gate in Shanghai. To meet Canadian safety standards, those will be a little higher. It might take 12 months or so. And Canadians who want a discretionary purchase like this, who don't care whether they were made by or displaced a Canadian worker on healthy wages, or comes at the expense of Canadian capital that is invested in manufacturing here at the cost of their ROI, they can fill their boots.
Okay. There is a limit on how many will be able to come to Canada. Does this limit the damage to the industry? And you mentioned the concern that this sort of gets cracked open a lot wider.
Look, the cap is important, and I do appreciate that was a guardrail that was negotiated, and the fact that there's a 3-year review. And so it does limit the exposure of the industry to potential damage, but we also have to be very serious about that. We have to be vigilant. Yes, of course, they're trying to use the opportunity to address an affordability challenge for EVs. But I also said, look, do you have a minimum price? Because if you don't have a minimum price and you're not very clear on that it's got to achieve the Canadian safety standards. I remember there was a time in this country not too long ago when we used to make the most popular transformative smartphone in the world, or we also had the best enterprise software and hardware companies in the world. But we lost Nortel to Huawei, and we lost Research in Motion, BlackBerry, to Foxconn and everything else. And there is a price to pay for buying things cheap.
Okay. You mentioned that the tariffs were wanted from the industry so that the Canadian industry for EVs could be bolstered or supported. How much progress has been made there? Well, look,
the tariffs were put in place at a time when we had just made major investments in the EV manufacturing sector and in the supply chain, hoping to access the U.S. market. And we always said the tariffs were a temporary measure that would help that fruit grow on a vine. I always thought it would be 3 or 4 years of protection. We've burned a year fighting with the White House. The caution on the Chinese is at the heart of it is healthy economies around the world have healthy, intricate manufacturing clusters that pull together hardware, software, raw materials, skilled workers, and traditional metals and plastics businesses. If you lose that and you're just a service industry or a service economy and a finance economy, you are vulnerable when we have crises, like when we needed things during the pandemic, and also this new world where everybody's new national security posture is prepare for war.
Okay, so you talked about the fact that the tariff was in place to allow the growth or support to really come forward in basically Ontario's manufacturing sector. Where are we in that sector? How do EVs compete, or Canadian-made EVs compete now generally?
Well, where we are in that sector is that Donald Trump got elected 14 months ago and said, we're going to remove any incentive for the U.S. market for purchase of electric vehicles. We're going to put tariffs on Canadian parts, raw materials, and vehicles. Now, we've managed to negotiate an exemption to the tariff on parts. He also said we're going to remove any production assistance for any of the companies in our region for parts, batteries, and vehicles. And of course, that triggered a couple of clauses here in Canada. So we are nowhere. We make some electric vehicles in Windsor plant, the Stellantis company does, and a lot of hybrids from Toyota and Honda, but we're nowhere. But I think the finer point is it isn't just about electric vehicles. The Chinese chosen path for the 6 million vehicles that they export around the world, by the way, we only buy 2 million here, so they have 6 million in exports, is cheap electric vehicles. So you have to make your defense on the electric side because you want to defend against the Chinese oversupply. If it's just on vehicles themselves, the Chinese aren't interested in selling us internal combustion engine vehicles. They flood secondary markets and the global south with those vehicles.
Interesting. All right, Flavio, I do have to leave it there. I'm out of time, but thank you for your time. I appreciate it.
Thank you, Marilla.
Coming up next, markets trading mixed today. Traders digesting the American president's recent comments regarding his upcoming Federal Reserve Chair nomination. More in a moment. No big swings for the markets today in North America. Our next guest says the key question for the markets this year is whether central banks have completed their rate cuts. Let's go to John Wilson, co-CEO, managing partner, senior portfolio manager, 9 Point Partners. Thanks for joining us today.
Thanks for having me.
Okay, so big picture for a moment. How do you see the economy shaping up this year in the U.S. versus Canada?
So the U.S. economy has actually been quite strong, right? We had pretty decent productivity growth in the back half of last year, especially the fourth quarter. So most people see good growth from the U.S. this year. Labor market has hung in well. We just had jobless claims, pretty much as good as they get, under 200,000. So yeah, the U.S. economy looks strong, subject to whatever Trump might do over the course of 2026. But as of right now, it looks great. Canada actually also has held in better than people thought when the tariffs were first announced. Now, partially that's because we negotiated some relief from that. But overall, the Canadian economy has been okay as well. Not as good as the U.S., but okay.
Okay, let's discuss where you see some opportunities for the year. Precious metals is one. What could give it another run this year?
Well, it's obviously been a great trade. We think that can continue. You have developed economies around the world all using fiscal stimulus, growing fiscal deficits. Central banks continue to add to their reserves with gold and de-emphasize the U.S. dollar. So all of that, is good for the gold sector. From a producer standpoint, obviously, there is a big margin now between the price of the bullion they produce and where their all-in costs are, and we think that's a great opportunity as well.
Okay, so are there one or two names you like in the space?
Yeah, of course. There's a number of names. I'd highlight Kinross. We think it's a low-risk way to play the sector. It's got producing properties in the U.S. that are running all-in sustaining costs anywhere from $1,500 to $1,700 an ounce. With gold at over $4,500 an ounce, that's a great spread. So it's a really low-risk, good producer. We think that's a great way to play the price of gold.
Okay. You also like natural gas for this year, which hasn't really enjoyed the same energy that energy sector has had because of AI build-out. What do you see there? Yeah,
this is more of a buy the dip kind of idea. Natural gas was at $4.50 an MCF back at the start of December of last year, so just a month and a half ago. It's at $3 now, so it's come down pretty much 30%. We think the marginal cost of production is around $4 an MCF, so you're not going to get a lot of supply growth here. But LNG is really continuing to come online in the U.S. and Canada, and that's going to grow demand by about 3 BCF a day. So there's a lot of demand growth, not going to be supply growth. The sector, has sold off the price of gas, and that's really because we've had a warm start to the winter throughout much of North America. So we think it can get back above $4, and there's some really interesting opportunities given where the price is.
Okay, let's talk about those opportunities. What do you like?
Yeah, we like Expand Energy. It's a U.S. producer. It's actually the largest producer of natural gas in North America. EXE is the ticker in the U.S. What we like about them, at their current production, they have 20 years of inventory. Their production is close to key sources of demand, whether that's LNG in Texas or the data centers in New York. And at $4 an MCF, you're looking at a 14% free cash flow yield. So, it's an opportunity to pick up a great name with great inventory after it's been hit pretty hard.
Okay, let's get to another space you like, and that is power, but more power generation. Walk us through your idea here.
Yeah, so power, I mean, people have been on this theme, obviously, with the whole data center, idea. We love, across the value chain in power, whether that's generation, distribution, backup, all of those areas. But one of the more interesting names we think is Rolls-Royce, and this isn't the car company. They were that split happened back in the 70s. Rolls-Royce, when it's a UK company, trades as an ADR in the US. They are basically half jet engines for wide-body jets, and the other half is split pretty evenly between defense and power generation. Their power business grew 25% last year. They also actually are an early leader in small modular nuclear reactors. So the UK has chosen them as the technology provider for 3 of those reactors. Czechoslovakia has them on the short list for 6, and they were recently added in Sweden as well. So pretty interesting name, growing earnings in the mid to high teens. We think there's some upside surprise possible there, and these types of contracts are really long-term contracts, so some good visibility.
Okay, we got to leave it there, but I appreciate you joining us. John Wilson, co-CEO and managing partner at 9 Point Partners. Coming up, the Prime Minister says China will lower tariffs on canola to about 15%. We'll talk more about the relief for Canadian exporters in just a moment. Tariffs on canola will edge down to 15% with a new agreement in place with China. We spoke about this with Rick White, CEO, president of the Canadian Canola Growers Association.
I'll start with seed, Andrew. That's by far the biggest component of the trade that we do with China. And on the seed itself, it looks like the deal is going to be that the tariffs on canola seed going into China will be dropped from the current levels of almost 76% down to 15%. Mm-hmm. So that's a significant drop and opening up the opportunity to get back into that market on the seed side. And typically we put about close to 6 million tons of canola into that market. It's worth about $4 billion. Mm-hmm. Very, very important. So that is good news. On the meal side, another significant contributor, I guess, to the canola shipments into China. Mm-hmm. And the canola meal tariff that was currently in place, that was a 100% tariff rate on canola meal as a result of anti-discriminatory investigation. So that has been zeroed out starting March 1, at least until the end of the year. So that is good news. Mm-hmm. On canola oil, nothing has changed in that area, but it's by far the smallest chunk. I'm not dismissing its importance, mm-hmm. but the 2 big ones were seed and meal, and we've got some good news on that one.
And the canola meal often used as a livestock and poultry feed.
Right. Yeah, that's what it's used for around the world is protein, and it makes excellent source of protein, especially in dairy cows. So it is required, and China has heavy demand for proteins like canola meal and other meals of oilseed products like soybeans.
I know you don't want to be getting into any kind of a shouting match with the Premier of Ontario, and you wish automakers well in Canada, but what would you feel if somebody said to you, well, yeah, but there's an opportunity cost here. We're going to be letting Chinese cheap EVs in here.
Right. Well, we were the subject of that decision to begin with, the political decision to do what triggered all of this. And at the end of the day, we are focused solely on what we needed and what our farmers needed to get canola trade back with our second largest export market, which is China. What it took to get there was political decisions. What got us here were political decisions historically, and it needed political decisions to get this resolved. Mm-hmm. So those decisions on what the trade-offs were to get this are the responsibility of the politicians and Prime Minister Mark Carney specifically. He made the call, but we are very, very supportive and very thankful to the group of the delegation that went over there, that politically went over there, because that's what it took to get this done. So to others, I would say canola is a major contributing factor to the Western Canadian economy and farmers in particular. There are other ways to deal with other parts of the economy, and the Prime Minister's made his decision on that.
Can you give me an idea now? I believe our canola exports in 2024 were something like $15 billion altogether to all markets. What kind of a drop-off did you see last year with China imposing those measures?
Yeah, the futures price certainly weighed heavy on the futures prices, and that's not the only problem, though, Andrew, because what farmers actually receive is a deduction from the futures price called the basis, and the basis levels had spread out even more than the futures had collapsed. So at the end of the day, what happened was there was significant value deterioration of the canola that was grown by farmers due to none of the factors that they normally would manage with normal markets and weather, et cetera, pure geopolitical risk here, and that's what happened, and that was what what created the deterioration in the value, and that was the problem, that farmers had all this production, it's in their bins right now, and the values were tumbling, and this deal will get those things back on track if we see canola actually being exported to China as a result. There's still tariff in there, but we are very hopeful and optimistic to some degree that the success of this will be determined by the movement of canola, the sales of canola going back into China. So the value recovery can start now if the demand is open up enough now that that we can get this product over there, and over time it'll even itself out.
Rick White, CEO, President of the Canadian Canola Growers Association. Last look at the markets before the end of the trading day and the end of the trading week. The TSX Composite not materially moved. It's 3 points up right now, but it could be hitting another record close just on that today. The S&P down 2 points and the NASDAQ a 10-point drop for the day. We're back with the closing numbers in just a moment. Stay tuned. Here are the closing bells for the end of the trading day and the end of the trading week. At the NASDAQ, buildgirls.org ringing the bell. And then in New York, the New York Knicks ringing the closing bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ended the day 12 points up, and that is another record close for the TSX. It's 33.40 is where it ended the day, beating the record close just yesterday of 33.28, I believe it was. Yes, it was. Okay. S&P 500, not a material move. It's 4 points down on the day. And NASDAQ dropping 14 points today. So, again, not a big move for either of them. Let's get to the movers in Toronto. Having a look at MDA Space to start up, it's 14.5% move up, 32% over the last year. That's a gain of $4.60 per share today. 36.29 is where it ended up. This is on upgrade news, and Stephanie Hughes will have more on that story in just a moment. Let's get to silver core metals. It had a gain of close to 11% today, so $1.55 per share, taking shares to $15.74. It's up 243% in the last year. Discovery Silver also a gainer today, up 7% or 64 cents. And they released their fourth quarter production numbers and got an analyst upgrade. That is what they're gaining on today. In the red, IA Financial is down 4%, a loss of $7.56 a share, taking them to $174.34. Capital Power also down today, dropping 6.5%. or $4.02 a share. And then Fairfax Financial also moving down today. It dropped over 5% to 2,436. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now to talk some more about the movers. Happy birthday.
Thank you. Thanks, Marilla. Happy Friday, and thanks for the birthday wishes. I'm looking at MDA Space to start off. Those shares gained by over 14% at their highest point, and that was the company's biggest leg higher since last August. So it's been a few months since we've seen a move of this magnitude. And like you mentioned in your remarks, it was because of an upgrade from Morgan Stanley, analysts moving the satellite developer to an overweight rating from an equal weight rating. That's kind of like moving a stock to a buy from a hold. And so the reason why was because they said that the company had been, its valuation discount had been too large compared to some of its peer companies. And there were a lot of catalysts, or in this case, good things going for the company to help it really stage a comeback this year. So the company has been regaining its momentum over the past couple of weeks and months, that is. After it had two abrupt sell-offs in September and October. So it had rallied earlier this month because it announced that it had been chosen for the Missile Defense Agency's SHIELD program. That's part of the Golden Dome strategy. So that puts it in place to bid on future tasks on the Donald Trump administration's growing defense initiative. So we're only about a half a month into the year, but it's been a pretty explosive growth for MDA Space shares already, the stock being up by over 30% year to date. It's been an incredible climb back upward for MDA Space, Marilla.
Okay, let's get to SSR Mining. That is down. What led to that drop?
That's right. So it's a bit of a gold story, just more broadly, but SSR Mining shares fell by nearly 6% at its lowest point, putting it among the bottom or the worst performers on the TSX today for pretty much the entire trading day, along with other gold miners. And that's because gold prices are buckling under a bit of pressure today after President Donald Trump's remarks, or comments about National Economic Council Director Kevin Hassett, praising him for the job he's been doing and said that he wanted to keep him where he is. So that's putting pressure on the gold prices today because Hassett was expected to be Trump's choice to be the next Federal Reserve chair and presumably take a more dovish stance on interest rates because Trump has been quite vocal, evidently, about his desire to get interest rates lower. So lower interest rates, the connection there is that it tends to benefit gold since it's an asset that doesn't pay interest. So that's what's causing spot gold prices to fall by nearly 2% earlier today. So it's not just SSR Mining. It is other gold and silver, precious metals names just in general that are under a bit of pressure throughout the trading day today, including Aya Gold and Silver, Ivanhoe Mines, Endeavour Silver, and others, Marilla.
All right, Stephanie, thank you for the update. Hope you have something planned for your birthday evening. Bloomberg, Stephanie Hughes.
Thank you so much.
Up next, we'll have another look at the markets. We're back in just a moment. All right, let's take a look ahead at 2026 and the market expectations with Matt Orton, Chief Market Strategist at Raymond James Investment Management. Matt, thanks for joining us today.
Great to see you, Marilla.
You see big opportunity for small caps this year in certain sectors or across the board?
That's exactly right. I see a lot of opportunities for smaller companies, just given the fact that their earnings potential, I think, is finally going to be realized. I do think you need to be specific about what you own in small caps. Last year, especially the second half of last year, was one dominated by low quality companies, companies that were more speculative in nature, those that had very, very high short interest moving higher. I think we moved to a higher quality phase of small cap investing and one where regional banks can do well, given the steepening yield curve that we have to positively impact net interest margins. I think biotech, increased M&A activity can do very well down market cap, and all of the companies just related to, I'd say, reflationary, cyclical reflation, given a lot of the fiscal tailwinds that exist in the overall economy.
Okay, you've been bullish on small caps, you say, since last summer. What sparked your interest in that point, at that period?
It's really an earnings story. So when I look at the underperformance of small caps for really the past 5+ years, the biggest thing has been that both top line and bottom line growth has not exceeded that of large cap companies. It's been a world dominated by the mega cap tech names. And while those names still have a lot of earnings horsepower and strength, we're finally at the point where I think the aggregate earnings across the small cap universe and the top line growth across the small cap universe can finally start to hit, if not exceed, that of the large cap space. And given how out of favor it is, how under-owned it is, if you add earnings to that story, I think that really sets up smaller companies to do quite well. Again, the key is owning the higher quality names that have those growth characteristics within them.
Okay, defense is another sector you like. We're seeing a lot of interest in defense, increased spending, of course, by governments. But you're looking more specifically at robotics in defense. Can you give us an example of that?
Absolutely. So I've been telling clients to play offense or defense, frankly, with defense. And with the advent of artificial intelligence and a lot of investments being made at the national level towards more precision missiles and especially towards unmanned missiles and unmanned vehicles, look at what's been happening in Ukraine and with Iran. We're seeing that there's a cost imbalance with respect to cheap, low-scale drones being used. That all fits within the robotics segment. And as we move into, I would argue, a more fractured geopolitical landscape, there's a huge investment cycle that needs to take place, not only in the US, but in Europe and in Asia, to get soldiers out of harm's way and use drones to do a lot of the front end fighting. So using drones in fights, using drones to counter other drones, that all fits very squarely in robotics. And I think there's a lot of tailwinds to go when you think of how big that ecosystem is, from the optics to the to actual building the muscles of the different robots. So there's a lot of different ways you can play that theme.
Okay. Are you looking just at the U.S. as far as the robotics and defense, or are you looking outside as well?
It is a global theme, Morella. So the U.S., I think, has been at the forefront a lot of this development, but you're seeing it happen in Europe. There's a number of European companies who are adapting and investing in robotics. There's also companies in Australia, in Japan, and Korea that I think are at the forefront of robotics. So there's a lot of opportunities to play this from a global scale, and also look at the suppliers. So there's a very diverse supply chain, and the supply chain of who's actually providing the inputs to make the end product, that is very much global in nature as well.
Okay, let's talk about AI. You are now moving away from the straight AI play to firms adopting it. Who's going to benefit from using AI? Does that include financials for you?
It does. Financials have been some of the heaviest investors in finding ways to integrate AI into what they do. There's also a huge case to be used for security within that as well, given, personal identifiable information. And so when you think about the growth of AI in companies where you're seeing continued investment, financials hit the list, but also think about transports, think about companies that rely more on data and crunching. The consultancy field, I think, is ripe for disruption with respect to artificial intelligence being used and adopted more in what they're doing. So there's a lot of parts of this economy where I expect over the next 12 to 24 months, you're going to see a lot more paid instances and a lot more of a push from the top, from management teams, trying to ensure that their workers are integrating AI into what they're doing to increase overall productivity. And you're already seeing that play out. Some of the GDP numbers for the US, productivity continues to support strong and resilient GDP growth here.
Okay. Are you expecting to see more of that in the current earnings season, the results of using AI to increase efficiency?
I think it's going to be a story that grows throughout this year. So while we saw some of it come from financial companies in this past quarter, but I think it's going to be more prevalent as we move later into this year, just because there's so many systems that continue to get upgraded. And I think we're also going to get a better sense, Morella, of who the winners and losers might be within the people who are providing a lot of the applications within the AI world as well. So we'll see who's signing big contracts to help actually let these companies enable users within artificial intelligence.
Okay, Matt Orton, sir, going to leave it there, but thank you for your time. Have a good weekend.
You too. Thanks.
Coming up, recent geopolitical issues remain a driving force for the crude market. We'll dive deeper into that when we come back. Continued protests in Iran have led to disruptions in oil production and shipping, causing a volatile week for oil prices. We sat down with Rob Thummel on this, Senior Portfolio Manager, Managing Director at Tortoise Capital.
There is probably zero geopolitical risk embedded in the crude oil price at the present time. So that, from our perspective, offers the potential for crude oil prices to rise just because of these added geopolitical concerns that seem to be rising, coming up every day.
That's interesting. So we've heard that for quite a while now, that the oil market seems remarkably calm about geopolitical risk. You don't even think that a bit of risk premium is edging into crude right now?
Maybe a mild amount, but not a lot. And if you think about what's going to happen, I mean, so it's all about geography, right? With Iran, and it's the Strait of Hormuz, right? And where Iran is geographically relative to the Strait. And as a lot of your viewers know, the Strait of Hormuz is very, very important. It's very critical in the transportation of energy products globally, right? But especially oil, because tens of millions of barrels a day go through that strait. And so if Iran would somehow, some way temporarily block that strait, that would cause really wreak havoc on the global oil market and reduce the supply, at least on a temporary basis. Now, obviously, there's a lot of interested parties, including the U.S. and China and others, that want to make sure that doesn't happen. But the reality is that the Strait of Hormuz is a really important point and a really important strait for the transportation of a lot of energy commodities around the world.
Yeah, I've heard it said this week that that would be a desperate move for the regime in Tehran, maybe one it would do if it really felt its back was to the wall.
Yeah, I think it is a last-ditch effort, but absolutely. But it would cause oil prices to rise substantially. So the more realistic view is, as you highlighted from the start, is will we add even more geopolitical risk to the oil price? And I think you could see the oil price rise a few more dollars from here as these tensions continue to rise. Now, if somehow we were able to everything was able to calm, then we still, the fundamentals are still the same, and they frankly still are, even without geopolitical risk. The fundamentals in the oil markets are still the same. The global oil market is oversupplied, and so that's why the oil price came down last year. And so until we get an adjustment in supply or higher demand, then we're probably just going to be seeing an oil price move with perceived geopolitical risk.
Where do you see oil going in the next year, Rob? I know that's an impossible question virtually to answer with so many factors, so many variables and wild cards. But do you see crude edging up despite fears of a glut?
We do, Andrew. I think what we'll see, and maybe it's over the next year is actually probably a good time frame to talk about. We look at it at Tortoise from an energy perspective as kind of energy experts per se over a much longer period of time. But what I would say is, yes, oil prices probably inch up. I mean, because we do think that you'll see less oil production, especially in the U.S. And so that will reduce the oversupply. Actually, I think from a consumer perspective, we'll actually probably see better demand than what we expect because of the lower oil price, both domestically and globally. So that'll help as well as balance the global oil markets. But longer term, the kind of the Goldilocks price scenario for producers and consumers is probably in the 70s, the low 70s range. And we think we get there over the longer term. We're not probably going to get there this year, and we'll probably still be in the 60s. But over the long term, we think we could see the oil price move up, in the low 70s at some point in time.
Interesting deal. I see Mitsubishi, the giant Japanese trading company, spending more than $5 billion to buy into U.S. shale natural gas.
Well, that shows you what people think of natural gas, right? And I think Andrew, you and I have talked before. At Tortoise, we are big fans of natural gas, not just in the U.S. but Canada as well, because of what's happening with AI, right? And as you know, we think electricity is going to become the new oil. Natural gas and nuclear are going to be the primary fuel supply sources. One of the reasons why the U.S. can win this global AI race is because we have low-cost electricity in here, because we have low-cost natural gas from the U.S. and, fortunately, from Canada as well. And so so we think that natural gas is actually a great place to be. We think natural gas demand is going to rise and grow steadily for not just a few years, but for likely decades. And so we are big fans of the opportunities in natural gas, all the way from the producer to the pipeline companies that operate the pipelines that transport it, all the way to the electric users that are generating power primarily from natural gas.
Rob Thummel, Senior Portfolio Manager, Managing Director at Tortoise Capital. Coming up, how Carney's deal in China will affect Canadian lobster exports. Back in a moment. Here are the stories we are following in the newsroom. Canada's reached a new trade agreement with China. The Prime Minister says Canadian tariffs on Chinese EVs have been eased in exchange for reduced levies on canola exports. All that takes effect by March 1st. Beijing will also drop canola seed duties to 15%, and in return, Ottawa will allow up to 49,000 Chinese EVs into the Canadian market each year at a 6.1% tariff. The Ontario Premier Doug Ford is condemning this deal. He says the agreement gives Beijing a foothold in the Canadian market and will be at the expense of Canadian workers. In a statement, Ford highlighted that Ottawa is inviting a flood of cheap, made-in-China EVs without any real guarantee of equal or immediate investments in Canada's economy, auto sector, or supply chain. Housing starts picked up across the country at the end of last year. Data from the Canada Mortgage and Housing Corporation shows the number of homes being built came in at an annualized rate of just over 280,000 units in December. That marks an 11% rise compared to the month before. Ontario, Montreal, and Vancouver logged the highest increases. Activity had been soft towards the end of last year as the sector dealt with all the economic uncertainty. WestJet will be going back to its old seating configuration after the company reviewed guest feedback on its proposed densified seating. The company says it will remove one row of seats in the aircraft that were densified, bringing back the previous legroom in economy. The airline CEO said the company will take what it has learned from the situation and continue to be cost disciplined and innovative. Talk a bit more about that agreement made with China and announced today. It also pulls back tariffs on Canadian seafood exports. Let's go to Jeff Irvin, Executive Director at the Lobster Council of Canada, to talk about this. Thanks for joining us. What's your first response to that announcement?
Marella, it was great news. We weren't exactly expecting it, but we were hopeful. It will help us regain our market position in the market for lobster in China.
How long was that 25% markup on lobsters in place, and what would you describe, or how would you describe the effect on the industry?
It came into effect in April, we've been dealing with it for most of 2025 and early 26. The impact has been our export value of live and frozen lobster went down by about half during that time, and it's allowed competitors to come in from Vietnam and Australia and take our market position. So we've got a bit of work to do to gain that back, but we're confident if we're back to just a 7% tariff, which is what we had before, that we can make that happen.
Okay. In that interim period, once the tariffs were introduced last April, was the Canadian industry able to pivot at all to send more to other countries?
Well, absolutely. I mean, we produce all the time, and so we need to have outlets for that product, live and frozen. So yes, we sold a lot more lobster to Europe, to other parts of Asia, to the Middle East, and especially to America, which we had a very strong year for frozen and live lobster into the U.S., where we are still operating with zero tariffs.
Okay. Do you make roughly the same amount of money in those markets as you would in the Chinese market?
Well, that's the complicated part. It's not an easy answer because short prices are different in different parts of the industry, different parts of the region. Some of the product goes into processing, which brings different prices. So in general, having China back will help us pay more to the harvesters and receive more from the market. So it'll be positive for prices and hopefully for profitability as well.
Do you think you can meet increased demand if it comes as early as March? I'm not sure how cyclical the business is.
Well, we're in a period of very little production in the winter. The lobsters don't trap very well. The water's cold. A lot of the processing plants are closed because it's winter. So, when we come out of the winter, the spring is a very busy time. Virtually all harvesting areas are producing. So, we'll rebuild some of those relationships through the winter, and be ready in the spring to supply live and frozen lobster in whatever volumes the Chinese need.
Can you expand a little bit, Jeff, on some of the countries you lost out to when China closed the market? Who does Canada compete with in that market?
Well, we compete with the Americans, who have the same species as we do, but we have a much higher volume than they do. But our main competition that's evolved is Vietnam. They have a farmed lobster from Vietnam that's become very competitive. And the Australians were out of the market, if you recall, for 4 years. They were in a dispute with the Chinese, but they're back in big time, and their volumes are back up to where they were before that challenge. So Australia and Vietnam have become very, very dominant suppliers to China. But we have a great market position. We have a great reputation. We have 2 claws that those other spiny lobsters don't have, and that's a unique feature. And we have good volumes to supply them. We have frozen, we have live. So I'm confident we'll get back in there fairly quickly.
As you know, trade rhetoric shifts all the time, right? We've seen it with the U.S. We've seen it now with China. I'm wondering how concerned you are about this happening, not happening, or changing quickly again.
Well, of course, in the last few years, we've become quite adept at pivoting and with geopolitical changes. So we're always nervous. We're more nervous about the upcoming free trade agreement negotiations with the U.S. America is by far our biggest market for lobster, frozen and live. Roughly 75% by value every year, year in, year out. That we need tariff-free access to America. That's the most important thing. So
right now, do they go under CUSMA to be free of tariffs in the American market now?
They do. All seafood from Canada is covered by CUSMA.
But you have concerns about a review and whether there could be a tariff introduced.
Well, sure. I mean, as you just said, we're concerned about everywhere until we have that tariff-free access. It's never guaranteed.
All right, Jeff Irvin, appreciate you joining us on the topic, sir. Thanks very much.
You're welcome, Morel. Thank you.
Coming up next, we'll continue and recap the coverage of Carney's visit to China, where that trade deal was signed in an attempt to diversify a little bit away, at least, from the United States. Back in a moment. We want to dig in on this new deal that Ottawa signed with Beijing with John Manley, former finance minister, chair now of Jefferies Securities. Thanks for joining us.
Thanks, Marilla.
So first impression of the scope of the agreement.
Well, I think it's an introductory phase. The scope is perhaps a little broader than we feared. It's not by any means what some people would call a free trade or a comprehensive trade agreement. But I think that it's the important signal here is that it's reopening the government-to-government relationship between Canada and China in a way that will support and enhance increased trade.
Okay, let's talk about some of the details. The winners, of course, are clear. Canola, Canadian seafood, but a lot of concern, as you know, in Ontario's auto industry about the Chinese EVs. Is their concern warranted?
Well, I think that they're concerned that this is a bit of a thin edge of the wedge. And I understand the urge to speak out in protection of an industry that is, in fact, very vital to Ontario and to Canada. But I think when you look at the details, first of all, it's not a huge number of vehicles. They're all EVs. Increasingly, some of the manufacturers are moving away from making those. They're at a low price point, below the average cost of vehicles in Canada right now. And therefore, they're not actually competing with anything that's made in Canada. So are they going to take a share of the market? Perhaps, but that's not tomorrow. It's going to take them time. They don't have distribution channels in Canada. They don't have repair and maintenance facilities. And I think that they've got a long way to go. So I think the test here, Marilla, is should Canadian consumers be given the option of acquiring these vehicles? And it's not just about the producers; it's also about the broad population. And I think that if the consumers don't want them, they won't buy them.
Do you think Ottawa should have secured dollar amount investments in the industry here to allow the Chinese EVs to come in? Because they're not being built here.
Would it be desirable? Yes. Was it a realistic objective? Probably not at this stage. We've shut the market. There aren't any of these, BYD vehicles in Canada at the moment, and so I think if you would look at it just from the point of view not of the Chinese but of any investor, if you're going to build something in a market like Canada, you want to know that there is a market for your product. We did this decades ago with the Japanese when Toyotas and Hondas started being imported to Canada, and they had built market share before they opened their factories and facilities. So I think it's not unreasonable to expect that the Chinese would want to take a look and see whether the Canadian market is open to their product.
Do you have concerns about Canada being more open to Chinese investment?
I think that, the late, great foreign minister and minister of other things, Mark Garneau, our first astronaut, said it well when he said that it's eyes wide open. So I think we have to examine foreign investment, not just based on from where it comes, but also increasingly based on whether it affords the investor a control point in the Canadian economy that should cause us concern. And increasingly, we're not in the world that we were in, 10 years ago. We're in a world in which we've got to look out for ourselves. We've got to know that we can produce the things that Canada needs in order to be able to maintain our independence, our sovereignty, and our economy. So I think we should be open to Chinese investment, but I think that we need to give careful scrutiny to any proposed investments and assess whether we think that the target is warranted, whether the investment is going to produce a benefit for Canadians, and whether it creates any kind of supply chain or other choke point that we would find difficult to live with.
Are you surprised then that Donald Trump has initially said he supports this?
Well, am I ever surprised by something Donald Trump does or say? I'd say he's completely unpredictable, so I've stopped being surprised by it. Did I expect him to say that? I think it would have been more likely that he grumble about it, and as some of his officials have. But I also have a sneaking suspicion that in the next few weeks, we're going to see some kind of trade agreement between China and the United States. So, Donald Trump has never been afraid of contradicting himself, in the same period of time, not sometimes in the same sentence, but I think he maybe has in mind that he's hoping to get a deal with China as well. And it would be a peculiar message to send in advance of that.
Are you surprised that energy wasn't part of this agreement? I mean, that would have been an obvious. We look at China and think they have a great need for our energy products.
Well, I think they want them, and I think we know that they want them. And I don't think that they are inhibiting their import to China in any way. So there's nothing really to agree to. The challenge is on our side. We've got to be able to produce the product and get it to them. And if we can do that, I don't think there's going to be any hesitation in their acquisition of energy products from Canada. And we should be looking at their strengths in the alternative energy areas as opposed to our conventional energy. I mean, they own the production of solar, for example. They are very strong in wind power. Their ability to to really leapfrog in renewable energies and in nuclear is nothing short of impressive. So we've got things to learn from them as well.
All right, John Manley, got to leave it there, sir, but thank you for your time. Appreciate it.
It's my pleasure. Thank you.
There have been recent AI privacy concerns surrounding X following the global backlash over the platform's AI chatbot Grok generating some explicit images. CTV's Rachel Aiello has more on that.
In light of growing global concern over Elon Musk's chatbot Grok being prompted by users to produce non-consensual, explicit, and sexualized AI images of real people, Canada's Privacy Commissioner is expanding an ongoing investigation into X and the social media site's use of Canadians' personal information to train artificial intelligence models. The use of personal information without consent to create deepfakes, including intimate images, is a growing phenomenon that poses serious risks to individuals' fundamental right to privacy, Commissioner Philippe Dufresne said.
Grok is the Wild West of AI. The technology has raced far ahead. The laws have had difficulty keeping up.
Elon Musk's companies were informed about the widening probe yesterday, the same day X announced it would limit Grok's ability to generate explicit images. As other countries crack down, Canada's Minister of AI says the federal government isn't considering banning X, but the Liberals are trying to pass new legislation to criminalize sexual deepfakes.
More trending tech stories when we come back. Meta is laying off over 1,000 employees as it tries to refocus part of its business. Let's look at that with our next guest, technology analyst Carmi Levy. Carmi, thanks for joining us. This is a pretty deep cut. We knew it was coming to the metaverse division, but will the division still stand after this?
Apparently it is. Yeah, this is bigger than expected. The number that we were hearing before the announcement came was about 1,000 jobs in their Reality Labs division, which was responsible for the metaverse-related products, particularly the Horizon Worlds app and platform. And the number now looks like it's closer to 1,500 to start with. So it's deeper than what was originally ordered. And I think it really exemplifies just how significant the pivot is away from the metaverse and toward AI. That Meta realizes it spent $70 billion on this boondoggle, got nothing out of it, an app that has barely a couple 100,000 users every month, and now needs to pivot pretty hard. So I would guess that this initial number is just the start. There will likely be more going on. However, the app at the center of this, Horizon Worlds, isn't disappearing. In fact, Meta has indicated that they will be looking for developers who specialize in building games on the Roblox platform. That's the gaming platform for kids, because they want to continue to develop immersive experiences for Horizon Worlds. They're not giving up on it. So a bit of a mixed message from Meta. It'll be interesting to see if they can actually succeed in getting some traction for an app that even the company couldn't get its own employees to use while they were developing it.
You mentioned it wants to refocus, as everybody does, on AI. How is it doing that?
So it's largely following an acquisition-based strategy. So it bought 49% ownership of a company called Scale AI last June. That was a $14 billion deal that brought the CEO and many of his leaders from the company over to kind of build that capability. They specialize in data structuring and annotating. So basically ensuring that the data is properly formatted before you train your AI models in it. The theory being the better you train the model, the better the output will be. That has been a significant problem across the industry up until now. And then late last year, they announced that they were buying Manus as a $2 billion buy. And this is an interesting company, founded last March, so it's barely 10 months old, and it's already generating revenue at a $100 million a year run rate. So one of the only AI companies anywhere that's actually generating that is revenue positive. And they specialize in agentic AI. And so they have a platform that lets you create AI agents to actually do complex workflows. and that is that obviously that is kind of the holy grail of AI. Agentic is supposed to be that next big thing, and this is a company originally founded in China, now based in Singapore, that seems to have the answer to that. Of course, the question now becomes, these are Meta's aspirations. Will they be able to get regulatory approval for this? Obviously, given the genealogy of the company, the fact that it was originally Chinese founded kind of suggests maybe there may be some headwinds there too.
Yeah, we saw what TikTok had to go through. Let's get to Apple, which will use Google Gemini for Siri. What do you make of the partnership? How long-term is this?
It almost feels like the Hatfields have met the McCoys in the tech industry, Morella, because here you have, these two arch enemies who've literally fought each other on every major platform, and now Apple is essentially giving up, saying that they could not develop the fundamental AI technology on their own to power the next major upgrade to Siri. That the vision of Apple Intelligence that they laid out at Worldwide Developers Conference in 2024, they simply can't deliver to it, which is a pretty big slap in the face and a major admission by Apple. But at the same time, Apple has a long history of working with partners to buttress them with other technologies till they can develop them on their own. They've done this with processors. In the past, they used Motorola and Intel for years before finally building their own. And so this is likely how it's going to play out. For now, at least, Siri is going to get smarter thanks to Google Gemini. But long term, it buys Apple some time to develop the technology, keep the iPhone relevant for as long as smartphones are generating over 50% of Apple's revenue, at least make it into that next chapter of the AI economy.
All right, Carmi, got to leave it there, sure, but thanks for your time. Have a good weekend.
You as well. Thanks so much, Marilla.
Time now to get to hot picks. We looked at 3 plays in Canadian midcaps with Graham Kreindler. He's Associate Portfolio Manager at New Gen Asset Management Limited.
So as we talk about our picks here today, starting off with Boyd Group, as you mentioned, it's the only way to play collision repair within the public market. And we like the stock because we like to find stocks that are at inflection points. And the industry's been in a bit of a challenging spot. The last 5 quarters, Boyd Groups have had negative same-store sales growth, and that was driven by higher insurance premiums and used car prices that were coming down. This basically made things more expensive for consumers to fix their car, and they were holding off. Now, what we're seeing here is the industry exit this downturn. Boyd finally had positive same-store sales growth in their last quarter. The trend continues to improve in October, so we like where things can go from an organic growth standpoint. The other thing is Boyd also completed an acquisition of another chain called Joe Hudson. It was a $1.3 billion U.S. acquisition. This is a very fragmented industry. The top 3 players, Boyd being one of them, only control about 25% of the industry. So we like to see Boyd do these types of M&As, these bigger deals, and roll up the industry. And what that all leads you to is the management team of Boyd has a plan to double their EBITDA by 2029. We think between the organic growth, the M&A strategy, we think it's very credible, and we think things will continue to trend in the right direction for them.
We have heard cars are so full of sensors now that even a minor accident can lead to scrapping of the vehicle. Are there implications there for Boyd?
I don't think it's necessarily a scrapping of the vehicle, Andy. I think what you're seeing is the average cost of repair go up over time. And those costs of parts and labor is ultimately a pass-through for Boyd. So that actually can help to continue to lift that same-store sales growth that I was talking about. So, complexity in cars is going up. And ultimately, that continues to create opportunities for the company, as well as things like scanning and calibration of these sensors, which is a higher margin revenue stream for them. You ultimately have to get that, back working in order, not just sort of patching up the paint and the parts.
Your next idea is Extendicare, and of course, senior housing, senior care, a growth industry.
Yeah, you said it, Andy. I mean, you look at the demographics within Canada, the cohort of Canadians aged 85 plus, that grows at about 4% a year. So that's a backstop for organic growth. Now, Extendicare is involved in long-term care facilities, which you mentioned. There's huge wait lists. There's a large shortage. They're also involved in home health care, so sending the healthcare practitioner to your home. That's growing at about 10% a year. And when you think about the shortage in long-term care, getting care in the home is basically triaging the shortage that we have in these longer-term care facilities. So we think that Extendicare will continue to grow in excess of that industry growth rate. They also completed an acquisition of a company called CBI, which is in home healthcare. That grew their employee base to by over 65%. This takes the composition of Extendicare, its profits, more than 50% of its profits are now involved in that higher growth, higher margin home health care. And I think a lot of investors still consider Extendicare to be involved in the real estate side of the business. We like companies when they're in the middle of a transition, when they're not yet fully understood, exiting or entering into this period of higher growth. We think it's a very exciting time for the company. The other thing is they haven't raised their dividend in 10 years. They raised it for the first time last year. We think with this new positioning of the business and how their balance sheet's positioned, we think that they can continue to pay out a strong and stable dividend moving forward.
Yeah, the dividend right now about 2.25%, I believe. So not too shabby.
Yeah, not too shabby, but I think the important thing is you like to see track record of growth over time. Raising the dividend for the first time in 10 years, that's certainly a signal, and we'll see how that trend's going forward.
And you said that half of their profits roughly now coming from this home healthcare service business.
Yeah, that's correct. So pro forma for this M&A deal that I mentioned called CBI, so they're now a bigger player. They are in the faster growing home healthcare segment than they are on the LTC and the real estate side of things.
And maybe we could just throw up a 10-year chart for Extendicare, because of course during COVID, those stocks were weak for a while. People concerned about safety in senior residences, etc. But that stock came roaring back.
Yeah, and I think what a reflection in that is the improved balance sheet over time. You've seen operating metrics and the occupancy in long-term care normalize, and then you're seeing this very strong organic growth in home healthcare that I mentioned. Putting up 10% or higher versus what's normally kind of a mid-single-digit growth business. I think that transition of getting a new investor base to look at the company as it reshapes itself. I think you're starting to see that bear fruit in the market here.
And finally, you got a nice diverse set of ideas for us here. Highlander Silver, what are they all about, and why have they caught your attention? Yeah,
in this market environment, Andy, I'd be remiss if we weren't talking about commodity stocks here. And I think the big question for investors, you look at the price of gold, you look at the price of silver, they're at all-time highs, and you're worried, have I missed the move? But we see opportunities within the actual equities that have significantly lagged the commodity. I mean, you look in the last 6 months, for example, the price of silver is up about 150%, but the equities themselves, if you look at the Silver Miners ETF, that's only up 90%. I say only 90%, but significantly lag the commodity here. We turn to Highlander. This is a TSX silver miner developing assets in Peru. I think the first thing you want to look at with a commodity stock is the people and who's backing the company. And this is backed by some of the most successful and biggest investors in commodities, names like Eric Sprott, the Lundin family, and Augusta Group. So we have a lot of confidence in the team there, and we think that the company's in good hands. When we look at the company itself, involved in Peru, which is a good mining jurisdiction, they have two assets. Their flagship asset of San Luis, that's one of the highest grade precious metal mines in the world. And then they recently completed an acquisition of a company called Bear Creek, and they got the Corani Silver Project, which is also in Peru. That's one of the largest permitted silver projects in the world. So some really big optionality within silver, within this company. But the rub is really within the valuation. And going back to the equities lagging the commodity, Highlander Silver trades at about 30% of its net asset value. The stock's around $6. Its peers trade at about 60% of their net asset value. So that would imply that the stock could double. Now, this is all being priced off of a $40 US silver price per ounce. Silver right now is trading at closer to $90 an ounce. So, let's say put an $80 silver price on the net asset value of the company, we think there's potential to double again. So lots of torque, lots of upside in this commodity bull market that we're in. And we like the backing, we like the asset package, so we think this is a great opportunity. The other two things are the company's going to look to list on the New York Stock Exchange, and also we think it'll get included into some of these mining indexes, which will help continue to improve trading liquidity and get people more access to be able to get involved in the name.
Graham Kreindler is Associate Portfolio Manager, New Haven Asset Management. All right, a quick look at how we ended the day on Bay Street and Wall Street. The TSX scraping out another record high with an 11-point move up to 33,040, beating the record high of only yesterday. Not a monumental move for either the S&P or the NASDAQ. 4-point drop for the S&P, and the NASDAQ down 14 points. A quick look at MDA Space, Canadian company that puts in low orbit satellites in place, gaining on a revision from Morgan Stanley, taking it to overweight. So a gain of $4.60 or 14.5% for MDA Space today. That does it for the close. Thanks for joining us. We'll see you on Monday.